For this mock exercise, we're going to take a look at a case called Ortega Limo Services, and it's all about the accrual counting concepts. And this question requires us to prepare and post adjusting entries, and we're going to go through the preparation of a trial balance. So let's take a look at the question. So this is the trial balance of Ortega as of December 31st, 2009. So what we have been given is essentially a list of all the accounts at the end of 2009. And they've given us additional information. So presumably this is what we call the unadjusted trial balance, because we haven't adjusted it for any adjusting entries. That's why it's called the unadjusted trial balance. And these are the information provided to us. There's 10 of them. And the first part of the instruction requires us to prepare T accounts and enter the trial balance account. 2, we're supposed to actually do a journal entry for December 31st, which is Ortega's year end, and then we're asked to prepare the adjusted trial balance. So this is the unadjusted trial balance. We need to adjust these with these adjusting entries to get us to the adjusted trial balance. So let's look at the first information. So you'll see we're told that the insurance policy has a 1-year term beginning March 1st. So this insurance, you see the word prepaid insurance here? For $3,600 is for the entire 12 months. We're told that that was bought on March 1st. And you can see that all of it is sitting at the end of the year. Now, how many months should be remaining in prepaid at December 31st. This represents 12 months. If they were bought on March 1st, so we've already incurred March, April to December, that would have been 10 months. So March, April, May, June, July, August, November, December, that's 10 of the 12 months would have been incurred as an expense. So only 2 months should remain as prepaid insurance, because those 2 months represents January and February's insurance expense at December 31st that was prepaid. So that's our first adjusting entry. So let me write that down here. So on December 31st, 2009, and by the way, these are all December 31st entry, you'll see that I need to debit insurance expense for $3,600, which is the amount of prepaid, times 10 over 12, so $3,000. And I need to credit prepaid insurance. Now, by not adjusting this prepaid, it means that the asset is overstated and the expense is understated for $3,000. Okay, let's look at the second additional information. We're told that a physical count of supplies at December 31st shows that we only have $570 of supplies on hand. But if I look at the unadjusted trial balance, I see that we have $2,500 of supplies. And in fact, if I don't adjust this, it looks like I have more supplies than what I actually have on hand. So I need an adjusting entry. So the second adjusting entry on December 31st as well is I need to debit supplies expense for, it was $2,500 sitting in prepaid. It should be $570. So I need to debit an expense for $1,930 and I need to credit supplies inventory. That's 1930. Okay, again, by not recording this adjusting entry, the current asset is overstated by 1930, and the expense, called supplies expense, is understated by 1,930. Okay, let's look at the third additional information. We purchased an automobile on January the 2nd, 2008. And they have an estimated useful life of 4 years. So you could see that they bought automobile of $58,000, and we already amortized. We already depreciated that equipment, that the automobile. So here, what we want to reflect is the use of that automobile in 2009. So that's one of our adjusting entry. And how do we determine that? It's going to be $58,000. And how many useful life? It's going to be 4 years. So the depreciation expense is $14,500. So I'm going to debit depreciation expense and credit accumulative depreciation auto. In this account, this is an expense, and we have to show the usage of that automobile to help us generate revenue. We have to show the respective expense because of matching principle. So that's the idea of allocating the usefulness of the benefit of that auto over the useful life each year. And this account, accumulative depreciation auto, is a contra account. A contra account is an account that is related to another account. And when we're looking at it, you'll see that this is essentially, if I look back at the unadjusted trial balance, I've already amortized or depreciate essentially 1 year's worth of usage. Because remember, we bought it in 2008. So this would have been 2008 depreciation, and now I'm about to depreciate 2009. So we're just going to add to this. And at the end of 4 years, this number will equal this number. That means that the asset has been fully depreciated. Now, looking at item number 4, the same thing again, furniture and fixtures was purchased on July 2nd, 2005, and they have an estimated useful life of 10 years. Okay, so we need to determine the depreciation expense for that furniture and fixtures. So again, that's an adjusting entry I need to do. I need to debit depreciation expense, which is $16,000 divided by 10 years. That gives me $1,600 per year. So that's $1,600. I'm going to credit accumulated depreciation furniture. Again, that's another contra account against the furniture asset account. Okay? Let's look at number 5. It says service revenue earned but not billed or recorded as December 31st. This is an example of accrued revenue, accrual. We've earned, we performed the service, and we have earned that in 2009, but we haven't actually billed it until 2010. Or 2010, correct. So therefore, I need to record an accrued revenue. And to do that, we need to debit accounts receivable. I'm going to put down as short form AR. And that accounts receivable, I'm going to record $1,750. I'm going to credit revenue. Okay. So item number 6, what do we have here? We have interest on a 7% notes payable. So the notes payable balance, if I look at the trial balance, it's $46,000. And it's a 7% notes payable that was paid on the first day of each quarter. So when I paid the October, it would have been for the third quarter. That means that we still need to record the interest expense for October, November, and December, 3 months worth of interest. Because again, it's called the matching principle, where we need to record expense incurred in the right period. In this case, we've already recorded the expenses from January to September. We just haven't, because we paid it, so we would have to record the expense when we paid. But now we need to record the last quarter of interest. So again, another adjusting entry on December 31st. We're going to debit interest expense. Now I always like to show the calculation underneath the entry to show how I got my number. In this case, it's notes payable of $46,000 times the interest of 7%. That's the interest annually, times 3 over 12, because that represents October, November, and December. And that gives me $805. And I'm going to credit interest payable. And of course, we're going to credit cash, debit interest payable on January 1st, 2010, when we finally pay the interest for the last quarter end. Okay, so now let's take a look at the 7th adjusting entry. The 7th adjusting entry, what do we have here? We're told that one of Ortega's customers paid in advance for a 6-month contract at a rate of $600 per month. The contract began on November, and Ortega credited unearned service revenue at the time. So this is a 6-month contract at a rate of $600 per month. The contract began in November, and Ortega credited unearned revenue at the time. So let's take a look. An unearned revenue, we have $3,600 here that's been recorded. So the entry that would have been recorded is debit cash, credit unearned revenue. And that was for November. So we need to now take out of unearned revenue a liability for 2 months, November and December, and that represents the revenue that were earned in 2009. So we need to, for entry number 7, we need to, again, December 31st, 2009, we need to debit unearned revenue, because now we've earned it, and that is $3,600 divided by 6 gives me $600 per month times 2 months. That gives me $1,200. Because now this is the amount of months that I've earned. I'm going to credit revenue. So right now, I should only have 4 more months of revenue that's sitting in unearned revenue that will be earned in 2010. Let's look at the next one, number 8. Number 8 says, driver salary totaled $230 per day. At December 31st, 3 days of salaries remains unpaid. So this is called an accrued expense. Again, we want to record the expense when we incur, not when we pay. So in that case, we need to record a salary expense for 3 days. So it's debit salary expense. That's 3 times $230 per day. That's $690. And we're going to credit salaries payable. Let's look at number 9. Number 9 says, on December 28th, Ortega paid $1,150 for January 2010 rent. So the amount that we paid for next year's rent should be a debit to prepaid rent. And if I look at the prepaid rent account, it already is recorded as a prepaid rent. So in that case, number 9, it actually was done properly. So number 9, there's no adjusting entry. As Ortega properly recorded the payment as prepaid rent. So they did a good job. They actually did it right. So there's no adjusting entry to be required. Required. Entry number 10 is income tax for the year are estimated to be $850. The company has paid $450 in income tax installment to date. So what they're saying is they have estimated, so they think that at the end of the year they have an expense called income tax for $850, but they already paid $450. And in fact, if I look at the income tax expense, you can see that they've already recorded $450 of that $850, which means that I need to accrue $400 of income tax expense in the current year. So entry number 10 on December 31st requires me to record a debit to income tax expense, $400, which is the $850 estimate minus what I've already paid, which means I've already recorded as an expense, and I'm going to credit income tax payable. Okay, so those are the rest of the journal entries. So now I want to post them to the T accounts. So part A or part B requires me to take the journal entries and post it to the T accounts. And what I've done is I've prepared the T accounts already. And you can see that what I've done is I've recorded the beginning balances or the unadjusted trial balance for each one of these accounts. So this is notes payable. So this one here we're going to ignore, okay? Now, we're going to post the adjusting entry to the T account to come up with a revised ending balance. So the first entry that we saw was debit insurance expense. Okay, and credit prepaid insurance. So I'm going to credit prepaid insurance of $3,000. I'm going to label that as entry number 1. And I'm going to debit insurance expense of $3,000 here. Entry number 1. Okay? Entry number 2, I need to debit supplies expense. Okay. Entry number 2, so this is entry number 2, debit supplies expense. I've already done it there. And I'm going to credit supplies of $1,930. So you could see that by netting the two, I should only have 570. And in fact, if you go back to the entry, it says that we did a physical count, or the adjusting additional information is we have physical count and we only have 570 left. You can see that this is the ending balance that we need to show. Okay. Entry number 3 requires me to record a depreciation. So I'm going to record a depreciation expense. The first one, entry number 3, is a debit to $14,500. And then I'm going to credit automobile $14,500. This is entry number 3. So my total accumulative amortization should be $29,000. Okay, and for office furniture, I'm going to debit $1,600 here for entry number 4, and I'm going to credit $1,600 here for office furniture, so that now in total I've got $5,600. This is my ending balance. Now, what's my total depreciation expense? It's going to be the sum of these two, which is $16,100. That's what's going to show up on my ending adjusted trial balance. Okay. Now, entry number 5 requires me to record that accrued revenue. And I'm going to debit accounts receivable, $1,750. I'm going to call that entry number 5. And I'm going to credit revenue, $1,750 here. Entry number 5. Okay. Now, entry number 6 requires me to record interest expense of $805 and credit interest payable. So I'm going to credit interest payable here of $805. That's entry number 6. And I need to debit interest expense $805 here. And that interest expense, if I add 24 plus 805, I get 3,220. That should be my ending balance. Entry number 7 requires me to record the unearned revenue of $1,200 and credit revenue. So I'm going to credit revenue of $1,200 here for entry number 7. And then I need to reflect unearned revenue of a debit for $1,200. That should only leave how many months? 2,400, and this represents 4 months. Okay, so we know that it should be 4 months of $600 each month. That should be what should be remaining as unearned revenue, because I still got 4 months to earn in 2010. Now, I need to add all of this. This is going to be my revised revenue, and this will be $118,550. That will be my revised revenue. Now, entry number 8 requires me to accrue salary expense of $690. So I'm going to debit salary expense $690. Okay, that's why my ending balance is $57,690. And I need to record a salaries payable right here of $690, having an ending balance of $690. Number 9, there was no adjusting entry because it was properly recorded. And number 10, we need to record income tax expense. and credit income tax payable. So you could see that the income tax payable I need to credit is 400. So that gives me my ending balance is 400. This is entry number 10. And we need to debit income tax expense of 400. So that gives me 950. Okay, so this one doesn't belong there. Okay, so now I'm ready to prepare a revised trial balance. It's called the adjusted trial balance, and all I'm going to do is look at all the ending balances for each of the T accounts. So let me just say that this is the ending balance for cash. Cash didn't change. So there's the ending balance, there's no adjusting entry to cash, right? Now, what about accounts receivable? We know that's the new balance. So let me just write this down. So I've got cash of 12,400. Accounts receivable is 9970. Prepaid insurance should be 600. That's what's left. And prepaid rent should be 1150. 1150, because we don't actually have any adjustments there. Now we know that supplies was 570, and automobile, we didn't make any changes. That was still 58,000 for automobile. Okay. And your cumulative amortized depreciation is 29,000. So this should be 58,000, and this should be 29,000 on the credit side. The office furniture, you'll see that the office furniture didn't change because there were no adjusting entry there. We didn't buy any that were unrecorded. And the cumulative depreciation was 5,600. So this one is 16,000 and 5,600. Okay. Notes payable, or in this case we have interest payable of 805. Interest payable of 805 is here. And salaries payable, we also have 690 here. We have income tax payable of 400. And unearned service revenue, we saw that to be 2,400. And of course, they're all in the credit side, right? Notes payable is 46,000. That did not change. Common shares did not change at 5,000. And retained earnings at 7,600. And by the way, this retained earnings is always the beginning of 2009, which is January 1st, 2009. It's always the case. Dividends, we only had one balance in there, 3,800. That's a debit. So now we're going to, and looking at the revenue, you can see that service revenue, we said it was 118,500. So let's record that in the trial balance. Salary, sorry, that would be a credit. Salary expense, we saw that to be 57,690. That's a debit. Rent expense is 4690. That did not change because it was actually handled correctly. Rent repairs expense. Okay, how much was that? 4690, right? So that was rent expense. Repairs is, sorry, the rent expense is $6,000. Apologize here. This is $46.90. This is $6,000. Okay. Supplies expense is $19.30. Gas and oil did not change, $20,075. Depreciation, we know it's $16,100. Insurance is $3,000. Interest expense is $3,220, and income tax is $850. So if I add all my debits and all my credit, I should be able to test for equality. And you can see that I was able to ensure that all my entries equaled. Debits equal the credit. So the answer is my trial balance balances. Now, this does not necessarily mean that the accounts were done properly or the entries were correct. It just means that I was able to apply the concept of debits and credits. I made sure that my entries did balance. My debit equals my credit. And I was able to post these journal entries in the T accounts properly without any error. Okay? And so this is the answer. Thank you.